in headquarters there carrying out their careers in boxes.
This has truly been a manic Monday on Wall Street. There's
Who knows where this is going to end up? I mean, this is volatility we haven't seen, of course, since way before you and I were born.
You know, this shakes your core. This shakes your trust in America.
In the fall of 2008, the world stood on the edge of financial oblivion. What began as a ripple in the housing market quickly escalated into a tidal wave that swept through global economies, leaving devastation in its wake. This was the collapse of Wall Street, the unraveling of decades of financial innovation, and the shattering of trust in institutions that were once thought unshakable. At the heart of this chaos was one name: Lehman Brothers, a titan of finance, a symbol of American capitalism, and a firm that had stood for over 150 years until it didn't. The fall of Lehman Brothers sent shockwaves through every corner of the globe, triggering a cascade of events that would reshape the financial world forever. But the collapse of Lehman wasn't just a singular event. It was the climax of years of greed, hubris, and reckless risk-taking that infected not just Wall Street, but Main Street as well. What happened in 2008 was the result of a system that had gone unchecked for too long, a system that put profits over prudence and speculation over stability. In this documentary, we'll take you inside the story of the 2008 financial crisis. We'll peel back the layers of complex financial products that fueled a bubble of historic proportions. We'll look at the decisions made behind closed doors at the highest levels of government and finance, decisions that would ultimately determine the fates of millions of people worldwide. This is a story of failure, but also a story of survival. It's the story of how the global economy teetered on the brink of collapse and how we're still dealing with the consequences today. Welcome to the Lehman Brothers Fallout, inside the 2008 financial crisis. By mid-2008, the cracks in the global financial system were starting to show, but for many, the true scale of the disaster was still unimaginable. Among the major players on Wall Street, Lehman Brothers stood as one of the most vulnerable. Founded in 1850, Lehman had built its reputation over more than a century as a conservative, well-managed investment bank. From its beginnings as a small cotton trading business in Alabama, Lehman Brothers had evolved into a financial giant. Yet, by 2008, the firm's decisions would lead it to the precipice of collapse. At the heart of Lehman's trouble was its aggressive embrace of the subprime mortgage market. While many financial institutions had exposure to subprime mortgages, Lehman Brothers took on more risk than most. During the early 2000s, the housing boom seemed like an unstoppable engine of profit, and Lehman dove in headfirst. The firm didn't just dabble in mortgage-backed securities. It made them the cornerstone of its business. Lehman wasn't just buying and selling mortgage-backed securities, they were creating them. The firm was a major player in the securitization of mortgages, taking pools of loans, packaging them into securities, and selling them to investors around the world. These securities were supposed to be low risk, as they were backed by real estate, a supposedly stable asset class. But as we've seen, many of these loans were subprime, made to borrowers with low credit scores or no ability to repay once the teaser rates on their adjustable mortgages reset. It was a house of cards built on unsound financial principles. For a time, this strategy worked brilliantly. In 2006, at the height of the housing boom, Lehman Brothers reported record profits of $4 billion. But beneath the surface, the firm had taken on an enormous amount of debt. Lehman was heavily leveraged, meaning it borrowed large sums of money to finance its investments. This allowed the firm to make bigger bets, but it also made it more vulnerable. If those bets turned sour, Lehman wouldn't have enough capital to cover its losses. Lehman's aggressive risk-taking was championed by its CEO, Richard Fuld. Fuld had been with the firm for decades and had steered it through numerous crises. He was known as the Gorilla on Wall Street, a nickname that reflected his aggressive, combative management style. Fuld had a singular belief in the firm's ability to weather any storm. He saw Lehman as a survivor, a company that had endured through wars, recessions, and market collapses. To him, the firm's investments in real estate would eventually pay off, even if the market experienced short-term turbulence. But Fuld's confidence was misplaced. As the housing market began to unravel in 2007, Lehman's position grew increasingly precarious. The value of mortgage-backed securities plummeted as defaults on subprime loans skyrocketed. What was once a source of massive profit for the firm became a ticking time bomb. Lehman was sitting on billions of dollars of assets that were rapidly losing value, and it had borrowed heavily to finance those positions. In early 2008, the firm started to show signs of serious distress. While other financial institutions were beginning to rein in their exposure to risky mortgages, Lehman doubled down. Fuld and his leadership team believed that the market would turn around, and they continued to pour money into real estate, making the firm even more vulnerable. They also tried to reassure investors that everything was under control, issuing optimistic statements about the firm's financial health. But the numbers told a different story. In the second quarter of 2008, Lehman reported a staggering $2.8 billion loss, its first quarterly loss in 14 years. This loss was a clear signal that the firm's problems were deeper than many had realized. Investors began to panic. Lehman's stock price plummeted as confidence in the firm eroded. In just a few months, Lehman lost more than 70% of its market value. Behind the scenes, Lehman executives were scrambling to find a way out. The firm needed to raise capital, quickly, or it would face a liquidity crisis. Lehman attempted to sell off parts of its business to generate cash, but potential buyers were reluctant. No one wanted to take on Lehman's toxic assets, and the firm's debt made any deal incredibly risky. In June 2008, Lehman raised $6 billion through a stock offering, hoping that this infusion of capital would stabilize the company. But the market wasn't convinced. Lehman's losses continued to mount, and the firm was burning through cash at an alarming rate. Its massive exposure to real estate, particularly commercial real estate, was dragging it down. Lehman had bet heavily on projects like the Archstone Smith Trust, a huge real estate investment trust that owned and operated apartment buildings across the United States. As property values plummeted, these investments became a financial albatross. By August 2008, it was clear that Lehman was running out of time. The firm's credit rating was downgraded, making it even harder to borrow money. Without new capital, Lehman would soon be insolvent. Behind closed doors, the U.S. Treasury and the Federal Reserve were becoming increasingly concerned. They had already intervened to save Bear Stearns earlier in the year, orchestrating a deal in which J.P. Morgan Chase acquired Bear Stearns with financial backing from the Federal Reserve. But Lehman Brothers was a much larger and more complex institution, and its collapse could have far-reaching consequences. In early September 2008, Lehman made a final, desperate attempt to save itself. The firm began talks with potential buyers, including Bank of America and Barclays. These negotiations were fraught with difficulty. Bank of America, one of the largest banks in the U.S., was initially interested in acquiring Lehman, but after examining Lehman's balance sheet, it balked at the scale of the losses. The firm's exposure to toxic assets was simply too great. Barclays, a British bank, also entered discussions, but any deal would require regulatory approval from both the US and the UK. As the weekend of September 13, 2008 approached, the situation became dire. Lehman was on the verge of bankruptcy, and the US government was racing against the clock to prevent a collapse. Treasury Secretary Henry Paulson and Federal Reserve Chairman Ben Bernanke convened emergency meetings with the CEOs of major Wall Street banks, hoping to broker a deal that would save Lehman. But unlike the rescue of Bear Stearns, there would be no government bailout for Lehman Brothers. Paulson was adamant that there would be no more taxpayer money used to bail out failing banks. The government wanted the private sector to step in. As the weekend wore on, it became clear that no deal could be reached. Bank of America had shifted its focus to acquiring Merrill Lynch, another major investment bank that was also in deep trouble. Barclays was willing to proceed, but British regulators refused to approve the deal unless the US government provided guarantees, something Paulson and Bernanke were unwilling to do. On the evening of Sunday, September 14, 2008, Lehman Brothers announced that it would file for Chapter 11 bankruptcy protection. The filing was made in the early hours of Monday morning, just before the markets opened. Lehman's bankruptcy was the largest in U.S. history, involving more than $600 billion in assets. The impact was immediate and devastating. Global stock markets plunged as the news spread. Investors, already on edge from the turmoil in the housing market, reacted with panic. The interbank lending market froze as banks became unwilling to lend to each other, fearing that they would be next to fall. Lehman's collapse triggered a cascade of failures across the financial system, leading to the near collapse of AIG, the world's largest insurance company, and prompting the U.S. government to step in with a $700 billion bailout known as the Troubled Asset Relief Program, or TARP. But for Lehman Brothers, it was too late. The firm that had survived the Civil War, 2 World Wars, and the Great Depression was no more. Its collapse sent shockwaves through the global economy and marked the beginning of the most severe financial crisis in generations. Millions of people lost their jobs, homes, and savings as the crisis deepened. The aftershocks of Lehman's fall would be felt for years to come as the world grappled with the consequences of a financial system that had run amok. As the dust settled on Lehman Brothers' historic collapse, it quickly became evident that this was not just a Wall Street issue. The entire global financial system was interconnected, and the failure of a single firm could and would send shockwaves around the world. The collapse of Lehman marked the beginning of a period of chaos in financial markets, a crisis that would spread far beyond the confines of Wall Street. Lehman's bankruptcy triggered a panic in financial markets, unlike anything seen since the Great Depression. Stock markets worldwide plunged, and the interbank lending system, the lifeblood of global finance, froze overnight. Banks, unsure of each other's exposure to Lehman and other toxic assets, refused to lend money to one another, fearing that they too would become insolvent. The result was a global credit freeze that made it nearly impossible for businesses and individuals to access the capital they needed to keep their operations running. In the weeks following Lehman's collapse, the financial contagion spread rapidly. One of the first major casualties was American International Group, or AIG, the world's largest insurance company. AIG had taken on enormous amounts of risk by insuring financial products tied to mortgage-backed securities, particularly through instruments known as credit default swaps. When Lehman failed, AIG was on the hook for billions of dollars in insurance payouts, and it quickly became clear that the company did not have the liquidity to cover its obligations. AIG's collapse would have been catastrophic for the global financial system. The company was so deeply intertwined with other institutions that its failure could have caused a chain reaction, bringing down banks and businesses around the world. Recognizing the severity of the situation, the U.S. government stepped in, injecting $85 billion into AIG to prevent its collapse. This was the first of several massive bailouts that would follow in the coming months, as the government scrambled to contain the crisis. But even as AIG was rescued, the situation in the broader financial system continued to deteriorate. In Europe, banks that had invested heavily in U.S. mortgage-backed securities found themselves facing huge losses. Financial giants like the Royal Bank of Scotland, UBS, and Fortis were on the brink of collapse, forcing European governments to step in with emergency support. The global nature of the crisis became clear as markets from Tokyo to London, Sao Paulo to Sydney, plunged into chaos. Central banks around the world responded with unprecedented measures. The Federal Reserve, led by Chairman Ben Bernanke, slashed interest rates to near zero and began pumping trillions of dollars into the financial system through a variety of emergency lending programs. The European Central Bank, the Bank of England, and other central banks followed suit, coordinating their efforts to stabilize global markets. But despite these efforts, confidence in the financial system remained fragile. By October 2008, it became clear that the U.S. government would have to take even more drastic action. Treasury Secretary Henry Paulson, Federal Reserve Chairman Ben Bernanke, and other top officials worked around the clock to craft a plan to prevent further collapses. The result was the $700 billion Troubled Asset Relief Program, or TARP. TARP was designed to inject capital directly into struggling banks, giving them the liquidity they needed to survive. It was a controversial plan, and many in Congress were initially opposed to the idea of bailing out the very institutions that had caused the crisis. But as markets continued to fall and the economy teetered on the brink of depression, Congress eventually passed the legislation in early October 2008. The injection of government capital helped stabilize the financial system, but the damage had already been done. Millions of Americans were losing their jobs as businesses cut back in response to the credit crunch. The unemployment rate, which had been around 5% at the start of 2008, began to soar, eventually reaching 10% by late 2009. Entire industries were hit hard: construction, real estate, and manufacturing in particular. The auto industry, once a cornerstone of the American economy, faced collapse. General Motors and Chrysler were forced to seek government bailouts to avoid bankruptcy. Meanwhile, the housing market, which had been the epicenter of the crisis, continued its downward spiral. Home prices, which had surged to unsustainable levels during the housing boom, plummeted, leaving millions of homeowners underwater, owing more on their mortgages than their homes were worth. Foreclosures skyrocketed, and entire neighborhoods were left with vacant, abandoned homes. The American dream of homeownership turned into a nightmare for many, as families were forced out of their homes and into financial ruin. The crisis wasn't just economic, it was deeply personal for millions of people. Lifelong savings were wiped out as the stock market tumbled. Retirement accounts, college savings funds, and pensions lost significant value, forcing many Americans to delay their retirement or rethink their financial futures. For those who had worked hard to build a life of security, the crisis represented not just the loss of wealth, but the loss of stability, of trust in the system. Across the Atlantic, Europe faced its own version of the crisis. Banks in countries like Ireland, Spain, and Iceland were heavily exposed to the U.S. mortgage market, and as the crisis unfolded, they began to collapse. In Ireland, the government was forced to guarantee the entire banking system, a move that would have long-term consequences for the country's finances. Iceland's banking system, which had grown rapidly in the years leading up to the crisis, completely imploded, leading to the collapse of the country's currency and a full-scale economic depression. In the years that followed, Europe would face a sovereign debt crisis, as countries like Greece, Portugal, and Italy struggled to pay off the debts they had accumulated in the run-up to the financial crisis. The European Central Bank and the International Monetary Fund were forced to step in with bailout packages, but the political and social fallout from the crisis would linger for years, fueling populist movements and anti-austerity protests across the continent. The impact of Lehman's collapse and the broader financial crisis wasn't limited to the developed world. Emerging markets, which had been growing rapidly in the years leading up to 2008, suddenly found themselves cut off from the global credit markets. Countries like Brazil, India, and China saw their growth slow dramatically as demand for their exports collapsed. In poorer countries, the crisis pushed millions of people into poverty, undoing years of progress in improving living standards. As the financial system crumbled, policymakers around the world were faced with the difficult task of not only stabilizing the economy, but also preventing a similar crisis from happening again. The debate over how to reform the financial system began almost immediately. Many blamed the crisis on deregulation, arguing that the removal of safeguards put in place after the Great Depression had allowed Wall Street to take excessive risks. Others pointed to the rise of complex financial products like mortgage-backed securities and credit default swaps, which had become so opaque that even the institutions creating them didn't fully understand the risks involved. In the United States, the response came in the form of the Dodd-Frank Wall Street Reform and Consumer Protection Act, passed in 2010. Dodd-Frank was the most sweeping financial reform since the 1930s, aimed at increasing transparency in the financial markets and reducing the risk of future crises. Among its key provisions were the creation of the Consumer Financial Protection Bureau, designed to protect consumers from predatory lending practices, and the Volcker Rule, which restricted banks from making speculative investments with their own money. But Dodd-Frank was not without its critics. Some argued that the reforms didn't go far enough, leaving too much power in the hands of the big banks that had caused the crisis in the first place. Others felt that the regulations went too far, stifling economic growth and innovation. The debate over the proper balance of regulation in the financial system would continue for years, with no easy answers in sight. The fallout from Lehman Brothers' collapse was vast and far-reaching. It changed the course of economies, governments, and lives around the world. And it raised fundamental questions about the nature of capitalism, the role of government in the economy, and the dangers of unchecked greed. As the global economy slowly began to recover in the years following the crisis, those questions remained unresolved. The world had learned hard lessons from the collapse of Lehman Brothers, but whether those lessons would be heeded in the future was another matter entirely. As the global financial system teetered on the edge of collapse in 2008, the world watched anxiously. Governments, central banks, and policymakers had managed to stave off complete disaster, but the damage to the global economy had been severe. In the aftermath of the crisis, the focus shifted from survival to recovery, but the path to rebuilding would be long and difficult. One of the most significant legacies of the 2008 financial crisis was the deep economic recession that followed. The United States officially entered a recession in December 2007, but the real economic pain didn't become apparent until after Lehman's collapse in September 2008. Over the next several years, millions of jobs were lost, businesses went bankrupt, and entire industries faced long-term decline. The U.S. housing market, which had been at the heart of the crisis, experienced a historic collapse. By the end of 2008, home prices had fallen by more than 30% from their peak in 2006. Millions of Americans found themselves underwater on their mortgages, owing more to the bank than their homes were worth. This wave of foreclosures displaced countless families and destabilized neighborhoods across the country. It would take years for the housing market to recover, and even today, the scars of the crisis can still be seen in some areas. The unemployment rate, which had been around 5% at the start of 2008, skyrocketed to 10% by late 2009. The auto industry, already struggling before the crisis, was hit particularly hard. General Motors and Chrysler, once icons of American industrial power, faced bankruptcy and were forced to accept government bailouts. The ripple effects of the crisis extended far beyond the auto industry. Retail, hospitality, manufacturing, and other sectors all suffered. Globally, governments followed suit with massive fiscal stimulus packages. In China, the government launched a $586 billion infrastructure spending program to keep its economy growing during the crisis. European countries, too, implemented stimulus measures, though many would later face their own debt crises as a result of the massive amounts of borrowing required to prop up their economies. But while these efforts helped stave off a complete collapse, the recovery was uneven. Wealthy individuals and large corporations who had access to capital and government support were able to recover relatively quickly. Wall Street, in particular, rebounded within just a few years. Stock markets surged, and many of the same banks that had been bailed out returned to profitability, even as millions of ordinary Americans struggled to get back on their feet. One of the great ironies of the 2008 crisis was that many of the financial institutions that had caused the crisis emerged even stronger after the dust settled. The largest banks, J.P. Morgan Chase, Goldman Sachs, Citigroup, and others, consolidated power as smaller firms either failed or were absorbed. The so-called too-big-to-fail banks became even bigger, raising concerns that the systemic risk in the financial system had only grown since the crisis. For many ordinary people, the recovery from the crisis felt incomplete. Jobs came back slowly, and wages stagnated for years, while wealth inequality increased. The stock market's recovery mainly benefited those with significant investments, while millions of Americans, particularly those in lower income brackets, found themselves left behind. For some, the experience of the Great Recession created lasting economic trauma, leading to a loss of trust in institutions and a deep sense of insecurity about their financial futures. The 2008 financial crisis remains one of the most significant economic events of the modern era, a stark reminder of the fragility of the global financial system and the far-reaching consequences of unchecked risk and speculation. In the years since, the crisis has left an indelible mark on governments, markets, and individuals alike, shaping economic policy, political movements, and personal attitudes toward finance. At the heart of the crisis was not just the collapse of Lehman Brothers, nor the bursting of the housing bubble alone, but a complex web of financial practices, regulatory failures, and institutional greed that culminated in disaster. It revealed how interconnected the world's economies had become, and how quickly those connections could unravel. For the millions of people who lost their jobs, homes, and livelihoods, the recovery has been slow, uneven, and, in many cases, incomplete. Wealth inequality has grown, and the gap between the rich and the poor has widened, creating a sense of disillusionment that lingers to this day. On a broader scale, the crisis changed the relationship between governments and financial institutions. It prompted reforms designed to make the system safer, but it also raised difficult questions about whether those changes go far enough. The too-big-to-fail institutions that played a central role in the meltdown are even bigger today, and the specter of another financial collapse looms large in the minds of many. Perhaps the most enduring lesson of the 2008 financial crisis is the reminder of how quickly the status quo can be upended. Complacency in the face of financial innovation, overconfidence in the market, and a disregard for risk can all lead to consequences that ripple through the world economy for generations. As we look to the future, the lessons of 2008 should not be forgotten, lest history repeat itself. In the end, the 2008 financial crisis stands as a cautionary tale of hubris, vulnerability, and the dangerous belief that the good times will last forever. The global economy may have moved on, but the crisis's legacy continues to shape the financial world we live in today.